Hello, everyone. Thank you for joining us today for this next panel. Hopefully you've been learning a lot throughout the day. We've touched on a lot of different themes and narratives, everything from regulatory to institutional. We just had a great conversation about NFTs from some leading founders and investors in this space. And this panel is going to be very special and near and dear to my heart. Some of the best venture capitalists in the digital asset space right now. This conversation is about supporting the companies building tomorrow, today. Myself, again, my name is David Nage. I'm a managing director at ARCA. And then we'll go around the table, quickly introduce yourselves, your firm, and then we're going to have a great conversation about venture and about investing in this asset class. So we'll start with Ken.
My name is Ken Seiff. I'm general partner at Blockchange Ventures, and we invest early in what we hope will be the biggest outcomes of the blockchain.
Haseeb.
My name is Haseeb Qureshi. I'm a managing partner at Dragonfly Capital, which is a global crypto investment firm, and we try to back the best entrepreneurs from around the world building in crypto.
Excellent. Miko?
Yeah, hi. My name is Miko. I'm a general partner with GCC, or Gumi Cryptos Capital. I've probably co-invested with all of y'all, and we definitely look to very similar early stage venture investment style, both equity and tokens.
Excellent. And then Robert.
I'm Robert Leshner. I'm the founder of Compound, and I'm an angel investor at Robot Ventures.
Excellent. So what we're going to do is have a great conversation. We're going to keep it very conversational, in fact. And one of the things I would love to discuss with you all is, as the title of the panel goes, we're thinking about, obviously, or you all are participating, investing in what I define as tomorrow, but today. And so I would love to hear from each one of you, and I have a feeling there's going to be a little bit of synchronicity here, what sectors you feel are being built today that are reimagining or potentially creating new opportunities, new paradigms in the world that we live in today. I'm going to start with Haseeb, if that's okay, and then we'll go to Ken, Rob, and then to Miko.
Sure. So I imagine everybody on this panel is going to mention DeFi. So to not be repetitive, I'm going to skip past DeFi. I think one of the most interesting stories going on today is that we've found ourselves in a very multi-chain world, I think faster than we expected to. Multi-chain was, I think, a story that first got seeded in 2017, this idea that instead of just being Ethereum, where everything happens, there are going to be multiple blockchains that all need to talk to each other in some way. And basically, the multi-chain reality arrived a lot faster than we built infrastructure for it. And so I think one of the things that's really missing that I expect to be an increasing area of investment and innovation over the next few years is, what is the right infrastructure that you need for a world where not all smart contracts live on a single chain and doesn't all speak the same language. So that's something we're looking at. I think that extends to both, what do you do with a Cosmos and a Polkadot? What do you do with all these other layer ones that are bridging back to Ethereum, like Solana and Binance Smart Chain and Matic, et cetera? And then, of course, what do you do with all the layer twos? All three of these ecosystems speak different languages, and I think we're going to need to see some way that we combine all these into one kind of meta system that all understands how to communicate with each other.
Excellent. We'll go to Ken.
Yeah, it's funny. I think we probably the easiest answers are going to be NFTs and DeFi, but I'm not even sure it's the best answer, because we're so early on in this game that if you were to just go backtrack 25 years to the early days of the development of businesses on the internet, and you were to ask the same question, you'd end up with an answer probably somewhere along the lines of the equivalent of infrastructure, NFTs, and DeFi. You get to infrastructure, email, media, and shopping, and maybe a couple others, maybe portals as well. That didn't work out so well. The email business doesn't really make a lot of money to this day. The portal business is completely gone. And the rest of them are actually very big traditional categories that have migrated online. So they were natural evolutions to go and use the internet. As we look at NFTs and DeFi, they're natural evolutions. So of course we can expect that, and we can expect banking and other areas of finance like lending to come online. I think what's really the most interesting is what couldn't be built in the last 100 years because the technology didn't exist that can now be built. And because you have blockchain technology. And we categorize that as the holy shit sector. And for me, that's the most exciting sector. It's the stuff that you never thought about because you don't have a real world proxy for it. And when you see it, you can't unsee it. When you hear it, you can't unhear it. You simply find this new thing that can be done for the first time, and your usual reaction is, holy shit. That's almost a precursor and mandatory requirement for the businesses that we invest in that are actually businesses as opposed to protocols. I'd add one more, which I think is so obvious because we've been saying it for 4 years, but this is the first time you can actually invest in this sector, and that's the layer one in particular, but the protocols. You couldn't buy into a protocol in the days of the internet. And so I do think we have to at least put that on the table as something that is really important. And in fact, in DeFi, some of what we think about as DeFi is really protocols.
Ken, I'm curious, what do you put in the oh shit sector that you've seen so far?
There are 3 companies for me that are in our portfolio that I put in that sector. The first one was Figure. And I say that because it's an absolutely natural first native digital asset category. So in the same way that books were a really natural first internet category for shopping, lending is an absolutely natural first finance category for the blockchain. And so once we sort of figured out how important it was to be a native asset to take advantage of the technology, Figure had its holy shit moment with us. I think we've had many more with them since then. So it's migrated from, for me, an existing business going online, like online shopping, to being something much more significant. A second one is Brain Trust, which is a marketplace of talent on one side, so really serious, sophisticated technology talent that freelances on long-term projects, and large enterprises on the other side. And there's no intermediary. All of the money passes from the hirers to the talent, but there's an entire token ecosystem that allows for things like referrals. And so that business is growing at a fairly rapid pace, in a large part because they've taken the blockchain technology and created a viral loop. And this couldn't be done without the blockchain or without a token economy. And I'd say a third one for us, which originally just started as a really good business and a migration, was Audius. But you look at their month-over-month growth and their recent announcement of NFTs, and what you realize is that the legacy technology companies, and I can't believe I'm calling them this, but legacy technology companies like Spotify and SoundCloud can't play, they can't compete anymore once you start to add things into the music business like NFTs. And so for me, the holy shit moment there was simply that music isn't just the songs itself, it's what can you now do with NFTs in the music business that fundamentally differentiated from anything we've seen before. Well, how it plays out, I don't know.
Well, I will tell Ryan Selkis I'm sorry that he needs to add a new sector in their taxonomy of holy shit. So we'll make sure that they get that done by the end of the day. Robert, to you, besides obviously being the founder of one of the largest and most pronounced DeFi platforms in the world today, you have been investing in early stage companies. What sectors, what kind of topics and narratives have you really excited, or in Ken's verbiage, gives you that holy shit type of feeling?
Well, it's funny because as a founder myself, I actually do this a little bit differently from most investors. So I actually don't think in terms of sectors. I don't think in terms of, what area somebody's working in. I'm really just looking to identify and back and support exceptional founders. When I started Compound, there was no word DeFi, but I was able to say that, we were building an autonomous financial market that worked 24/7 and was open to everyone in the world to create a giant interest rate market. There was no sector for DeFi. And similarly, I'm just looking to identify, other founders who are interesting and passionate and intelligent and capable. And it's kind of sector agnostic. Most of that winds up being DeFi in a lot of ways because, I get to meet a lot of folks who are interested in DeFi, but, I invest in things that aren't even crypto, sometimes. So it really comes down to just trying to identify and support the best people entering the space.
Robert, wouldn't you say that, because you just hit on something that I'm really kind of passionate about, wouldn't you say that at the end of the day, if something's a sector, it's already competitive? And that when you look back at the greatest investment outcomes, search didn't have a sector, or social networks didn't have a sector when the early social networks and the early search engines emerged. And so I don't know if that fits in with your thesis as well, but maybe that's why it becomes more about founders than sector.
Yeah, and I'm also investing much earlier stage, sometimes in teams that are pre-idea, right, where it's just an absolutely exceptional set of founders. And so, I do think by the time it's a sector, you start to see almost a commodification. I see hundreds of DeFi pitches a week, that I just call generic DeFi, that all sort of blends together, and most of which isn't investment grade.
Makes sense. Miko, I'll throw it to you.
Yeah, so my psychology here is kind of yes and, right? Which is that, it's sort of the founder thing is super big for us. We look for what we call a Gumi corn founders, so we're absolutely thinking about the humans. We're, if you think about it categorically, it's absolutely this kind of, the usual suspects, right? So obviously the oh shit thing is super important to us. And, I'm excited about collaborating with Ken on something that's coming up the pipe, but hasn't been announced yet. But, for me, I guess I just wanted to talk about sort of the future of the future, which is I come from maybe 25, 30 years of open source software. And to me, I've been thinking about how basically consenting to rule-based environments creates freedom, right? And so I'm interested in looking at kind of how these systems interact in the future. So I would say, it's a sort of an abstract statement, but I guess to make it concrete, one of our recent things was Yield Guild Games, right? So that's a really exceptional founder and a really interesting opportunity because, one way of framing it, it's a play to earn gaming guild, right? So, it's sort of, we're investing in guilds, gamer guilds now. That's very strange, right? But, to me, it's the rise of the NFT renaissance and then the skilled trade guilds, right? So in essence, this idea that the humans are a choke point in a platform fragmented and an experience environment fragmented world of NFT, it's just like, our previous investment in OpenSea, we're looking for horizontalities, right? We're looking for things that transcend. I mean, I think Haseeb said it well, which is he's looking for this multi-chain thing, right? So an NFT, it has to be a multi-chain. You have to find things that aren't tied to a single chain necessarily, or tied to a single experience environment necessarily, right? And in the case of Yield Guild, it's sort of the first, labor union, and I think to me, if we reason about why the market wants there to be a really big one of these, the best way to reason about it is to think that why does the world want there to be a big United Auto Workers Union, right? Which is, it's collective bargaining, right? So the market wants there to be a big one of these for expanded collective bargaining, because ultimately the players of play to earn are going to want to bargain with the games. They're going to want to negotiate with the games, and they may even do a labor strike. They may even go to another game. So this is governance in action. So, I would say that's a super futuristic one. We are also investing in much more pedestrian things, but I think the space is going to be so big that I think that stuff is all going to work out pretty well.
Agreed. I'll answer my own question, and then we'll jump into the world of DeFi. A lot of what's been echoed here in DeFi specifically, I am seeing the early stages of righting some wrongs. I think that it's wrong that 1 billion people on the planet do not have access to the capital markets because they don't have an identifier, that they don't have the ability to get a credit score. And there are companies out there like a Teller Finance, which were addressing that, bringing real world data into the blockchain. And I think that is one of the missions of this whole entire space, is to bring the entire world into this. Not only those that are the top earners or the top performers out there, all of us. And I think that's a very altruistic and very capable project right now. In addition to that, Miko alluded to something that I think is incredibly important in terms of gaming. The total addressable market of gaming right now, there's 3 billion people around the world that participate in games every single day. And as a father of 2, I've seen my children play certain legacy games out there where it is a constant siphon of capital, of money, to buy avatars, to buy different swords, et cetera, et cetera. And then when they get tired of that game or they move on to another game, it's lost, that capital is lost. Those assets are no longer theirs. And so this idea of ownership, of digital ownership, has been something that we have been missing for decades with the advent of the internet. And so with DeFi, with NFTs, and as Haseeb alluded to in this idea of interoperability, we have seen over the last few years that there have been many pieces of the puzzle. There's been search, there's been query, there's been indexing of data. But a lot of those pieces have not been able to speak very well to each other and work very well together. And with interoperability with projects like Cosmos and others out there, you have the possibility of that being alleviated and bringing into these different pieces of the puzzle to create platforms that are rich and beautiful and performant like we usually see today. And so these are some of the things that we typically look for as well. And so love all your answers on that. And then we're going to move to DeFi now, the kind of 800-pound gorilla in the room again, and talk about how this has happened. You know, obviously, Robert, you have been from the ground floor, as you alluded to. You were building before DeFi was even a word. And so I'm going to start here with you, and then we'll move over to Ken and to Miko and to Haseeb. And so with DeFi, specifically over the last year, we've seen the amount of capital, the total value locked, one of the metrics that we use. In the end of April of last year was $800 million. And as of today, it's about $56 billion. And so we've seen just tremendous growth there. I'm curious, as you've been at the ground floor, as you were building before anything was really happening here, give us some of your kind of vision here. Obviously, you started from day zero. Talk to us about from day zero to where we are today, and then give us, the 6-year down the road vision of what DeFi is going to look like, in your opinion.
Yeah, absolutely. So from day one, there was really 2 different theses that, have guided everything that I've done to build Compound and also guide a lot of what I'm doing as an investor in the space. So the first is a vision that eventually all assets are going to be administered and tracked on blockchains instead of using spreadsheets and contracts. This goes for pretty much every financial asset there is, from stocks and bonds to currencies to all records of ownership. Eventually will be on blockchains. This is not going to happen tomorrow, but over the next 20 years, we're going to see every single asset getting sucked into blockchains that exists. Okay, and this is a slow transition. And the second one is that all of the products and financial markets that exist for assets today will also exist on blockchains. However, they might not look and feel the exact same. So, when I started Compound, pretty much the only thing that was happening in crypto was trading. There weren't really other financial products for the most part. There was a little bit of BitMEX perpetual futures, but other than that, it was almost all trading on spot markets. And the second thesis is that eventually all of the products that we're used to in legacy finance will make it over to these assets on blockchains. Why? Well, there's hundreds of years of evolution that have gone into creating these types of financial markets and products. It's not by accident for the most part. So obviously we're going to replicate everything that exists, plus new types of products that are more attuned to things that are only possible when everything's running on a blockchain. So these 2 things coming together were sort of the opening for Compound. It was saying, hey, there's not really that many assets living on Ethereum yet. Most of them have funny names, but and a lot of them were coming from 2017. But there's assets here. And the only thing that you can really do on the blockchain is trade. There was starting to be very early, work in decentralized exchanges, but that was it. And so, my guiding principle was what financial market doesn't exist, the ability to earn an interest rate and to borrow an asset. And the use case for that is going to increase exponentially as more and more assets become tokens. And so it was really that, simple, 2 theses coming together that was the sort of initial founding principles for Compound. And I think right now what we're seeing is both of these, trajectories playing out. We're seeing more assets. That piece is still a little slow. It's a lot of crypto native assets, but we're seeing every single financial product and market being replicated, sometimes improved significantly from the way it operates in legacy finance in DeFi.
Great. We'll go to Ken.
Yeah, I'm reminded of old media companies when I look at DeFi and I compare it to the legacy financial world. The legacy financial world is just fundamentally broken, and but it's good enough, like especially in the U.S. So we actually don't realize how much is missing in the third world. We don't realize how bad we have it because we don't have anything better, and you got easy ways to move money in a way that we think is digital, which really is not digital. It's very centralized. And so the early products, as Robert said, they're somewhat limited because there's a limited number of native digital assets. And it's much easier to move something that exists onto the blockchain than to invent something new. And it took us, just for context, it took us more than 10 years of the internet to come up with Facebook, and more than 6 or 7 years to come up with Google. And there were a lot of people working on the internet before those two businesses were invented. So what we're seeing now in this evolution of DeFi is just really, really early days. And as Robert says, and I couldn't agree more, every asset's going to be originated natively on the blockchain at some point. I think 20 years is the right horizon. Some will be sooner. The 2008 and 2009 financial crisis, I think, probably will lead to loans being originated really rapidly on the blockchain. I think that migration is going to happen. Companies like Figure can save 100 basis points or more in that process. That's a lot of money, but it's the transparency in a bad market that the blockchain has that the traditional world doesn't have. So I think the way I'd look at it is I would say old media to new media. The early new media companies, if you go back 20 years, were like the Daily Candies of the world, which were amazing hits, but they were just the precursor to the Twitters and Facebooks that were to follow over the decades. And that's where we are. We've got the Daily Candies right now. I think there's a lot of promise in some of these early DeFi companies and a lot of talent. And so we may see enormous evolution. And I mean, at some point, Robert, it'd be really interesting to hear where you go, because I think where you go is a lot more exciting than where you are. And I think that's true for the whole space.
Agreed. And we're going to throw it to Haseeb. I want to make sure everyone is aware that there is a Q&A feature here. So if you do have questions, and I see some have come in, I'm going to try my best to get to them. We're going to talk a little bit more about some topics, and I'm going to make sure I try to flood in some of those questions because they are great. Haseeb, the question is to you again about kind of where we are in DeFi today as opposed to where we go in the next 6 months or 6 years.
Yeah, so I think to echo both what Robert and Ken have said, I think it's very early for DeFi. There's still a lot of problems that are fundamentally unsolved. Right now, basically, we have two things working in DeFi today, which are trading and then lending and borrowing / yield. But there's a whole universe of other things that have yet to really get unlocked. So one of the things that I'm most bullish on over the short to medium term is synthetic assets, which is basically the idea that you can create derivatives that track the underlying price of basically anything, provided you have a price feed for it. So we already have some derivatives platforms like Synthetics and Mirror and UMA, but they're really quite small and they don't have a whole lot of traction yet. But it reminds me very much of what stablecoins looked like back a couple of years ago. At the time, stablecoins had maybe something like $2 billion worth of stablecoins total in issuance across blockchains. And at the time, it was incredibly obvious to me that stablecoins were just going to explode, just because, of course, the demand for dollars around the world is absolutely enormous. And blockchains are just a better, faster, more convenient and more powerful way to be settling dollars from anywhere in the world. In the same way, you have platforms like Mirror or UMA, which allow you to create a synthetic, a derivative that tracks the value of Tesla or that tracks the value of Apple stock, or the S&P 500, or gold, or whatever else you want, provided you have some oracle or some data feed of the underlying price. This is one of those things that, no matter how you look at it, there's no way this is not going to become huge 5 years from now. At the point at which, obviously there's a lot of infrastructure problems that need to be solved, a lot of onboarding problems that need to be solved, but the point at which you have tens or hundreds of millions of users on public blockchains, this is one of the most obvious things that people are going to use en masse, is have access to this kind of global marketplace that can allow you to buy and sell pretty much anything, provided that all you need in order to get access to that is a mobile phone and a crypto on-ramp. And then from anywhere in the world, you'll have access to what you and I have access to as members of the first world in a relatively free and open economy. I think one of the things that crypto, in the early days, especially in 2017, there was this idea that crypto was going to displace everything. That crypto is going to displace social media, it's going to displace traditional companies, it's going to displace search, it's going to displace Uber, it's going to anything that you can imagine. Crypto is going to somehow get in there and just drive a wedge into the old way that things are done. And I think this is a little bit too sanguine and a little bit too simplistic about where blockchain and crypto introduce unfair advantages. To speak of the old world, as Ken put it, a lot of those companies are actually some of the most beloved companies in the world, and they're also some of the most vibrant and some of the most fast-moving and innovative companies in the world. But if you look at banking and finance, this is some of the oldest, most captured, most overregulated, most non-innovative, lowest NPS scores, least consumer trust companies in the world. That most millennials and certainly the vast majority of Gen Z are like, why do these even exist? Why do we even have these? Most people of that generation trust Google and Facebook way, way, way more than they trust their banks, much less their own governments. And that, of course, is just in the first world. In developing economies, it's even worse, the relationships between individuals and financial companies. So this is a place where I think crypto, despite all of its disadvantages, crypto is slower, it's more expensive, it has all of these issues around the complexities of living in the decentralized technology world. The one place where it really unequivocally just wins and is a better architecture is in finance. And that's where I expect to see over the next few years the biggest gains made in the crypto economy.
I too love the old days, and one of my favorite places to go was Blockbuster, but I don't miss it anymore with Netflix. So funny what innovation does to you on those kind of narratives. Miko, the question to you, and then we'll move over to some questions from the crowd.
Absolutely. So I definitely am a little bit more, I guess, give it the 20-year horizon, a lot more hyper bullish than Haseeb in this sense, right? Which is, admittedly, there's a lot of chunkiness. My friend Dave McClure just tried to buy an NFT in an auction, and he was just pissed. He was just like, "What the hell is this thing? And why is it so horrible?" And so we got a ways to go here. But what I said earlier is really in support of what Robert was saying about how everything's going to get in here, right? And the question becomes why. So earlier when I talked about games, right, I really talked about games in the context of basically the freedom that results from consent to a rule-based system, right? So you're basically willfully entering a rule-based system and you're consenting to abide by those rules. That describes DeFi, it describes blockchain, right? Because the thing that's interesting, it describes governance, right? So the thing that's so interesting, like Metakovan said something super interesting, which is, he's the people buyer. He said that basically blockchain is the new America, right? And he really thinks of it as this conceptual layer that defines the new freedom, right? And the thing that's so interesting about this definition of freedom is that it's not a definition of freedom that's like, we have guns, so you can't tell us what to do. It's a definition that is about essentially a consent to agree to a set of rules, right? So we're joining. So here's what I'm really saying. What I'm really saying is this, is that people go to games because they expect to be treated fairly, right? And the thing that's amazing about something like Bitcoin is you can't point to a transaction in Bitcoin and say that's not an accurate record of what happened according to the rules and the laws of Bitcoin, right? So to me, if you look at it from that perspective, there's no rage quitting Bitcoin. There's only going to things that you think are a better game, like maybe Ethereum or maybe other systems that may be a better game. But you don't go away from it feeling cheated by it. right? So to me, what I'm really asserting, and obviously when you talk about the future, that's the future of freedom. It's the future of consent. It's the future of submitting to these rule-based systems that I call games, right? And so, I mean, getting it to the practical of like, how do you deal with that today, right? Like we see huge opportunity. I think Haseeb is totally right to point out derivatives, but the thing that's amazing about where we are today is that you got to roll up your sleeves like crazy, right? Like, for example, like Vega Protocol, one of our portfolio companies, like you actually have to get all the way down to fairness, right? Fair ordering of trades. And it's effectively the algorithmic elimination of minor extractable value and front running, right? You have to get all the way down to that level even to just surface a derivatives product, right? Or if you take something like 1inch, like how do you surface a user experience of DeFi? Well, you have to get all the way down into the guts, right? You have to get down to the gas level. You have to get down to the DEX aggregation level. You have to get down, even to implement a user feature like best price, you have to get all the way down into the plumbing layer, and I guess a shout out to, Hashflow, which is a, one that we're doing with Haseeb, which is, just another one of these kind of, how do you deliver user experiences like best price, without getting all the way down to the bottom of things. And that's where we are today, right? Which is, delivering even the simplest user experiences requires you to roll your sleeves all the way up to your elbows and get in.
So it is becoming apparent that Mike Cagney, Ronil Rumberg, and some of the other founders are very lucky to have you as investors, because you're doing a great job bringing them up and talking about their successes. And that's obviously one of the jobs as a venture capitalist, is to promote the companies in your portfolio and to educate those around you. And so I celebrate you for doing that. John Erickson has a great question. Do you envision the lending protocol to get business enterprise level funding or remain primarily consumer? And we will start with Haseeb. Yep.
I was not expecting that order.
Okay.
All right. Do I expect it to remain mostly consumer? I think in the short term, certainly. I mean, right now it's vast majority consumer. I mean, there's some companies like Celsius or something that are using these on-chain lending protocols, but for the most part, it's today. I mean, enterprises are a little too. They're mostly a little too scared to be touching this stuff. They don't exactly know how it falls under the rubric of compliance and all the other things that they need to be attentive to when they're thinking about engaging in markets. But that's in the process of changing. So I think we've got a number of protocols that are experimenting with having essentially KYC'd borrowing and lending pools that allow them to, again, without an intermediary, to have a compound-like protocol in which purely KYC'd actors can borrow and lend from each other. But right now it's still early days. There aren't that many sophisticated actors that are ready to do this, but I expect over the next 2 to 3 years, that's going to change.
There's a really interesting business called SkuChain, again, promoting a portfolio company that is targeting enterprise lending in an incredibly novel way. The lending's done on the blockchain, but rather than lend directly to the company, it lends to an SPV. So a group of people lend to an SPV, which then lends to a company against a purchase order. And then that company can translate that purchase order down through its supply chain. So everybody in the supply chain can borrow for that order at the rate of the highest person in the supply chain. There's a Fortune 5 company that's actually implementing that in the beginning phases right now. If that happens, you can see it ripping a lot of costs out of the supply chain, because a low-level material supplier cannot possibly borrow at the same rate as GM or Apple or Deutsche Bank. And so, if that were to come to pass, and you could take hundreds of basis points out of a cost structure, I think you'll see enterprise adopt it right away. But otherwise, we're probably likely going to see consumers first, because they take the most chances and the most risk, then institutions, because they go where the money is, and then eventually enterprises, who are much more cautious, maybe more technologically averse and just slower to adopt and have to make a different set of internal sales to get permission to do anything new, particularly when it comes to technology.
I'm going to stick with you on that, and then it's going to go over to Robert. So Gavin, and we'll get to Miko as well on this. So Gavin asked a question which also kind of ties into this. How do we move past over-collateralized loans to get more traditional, in quotes, loans that allow people to get more than actual currency value, i.e., how do we get loans like car loans or mortgages on blockchain, and what does that look like? Now, Ken, I know obviously Figure is in the portfolio, and you've talked about them, so I know this kind of envisions into that. And then, Robert, I'd love you to opine about that as well, and then we'll get to Miko.
Yeah, well, just to push back on the one who asked the question, both car loans and mortgages are over-collateralized as well, right?
Nailed it.
Most things in finance are over-collateralized because it makes it really easy because it's not based on somebody's character. Whether it's using securities or cars or houses as collateral to borrow against. So obviously all these things are coming. We're in like chapter 2 of a really long book of all the things that DeFi is going to eat. But obviously there's going to be mortgages and auto loans and all of these things done correctly on blockchains within the next 20 years.
Ken?
The only thing I'd add to that is the reason there's over-collateralization is there's a massive amount of volatility. And so the risk is really pronounced when you have volatility. If the volatility disappears, a lot of the risk disappears, and therefore the over-collateralization disappears. And whenever you have an asset class where components of the asset class grow from $0 at startup to $1 trillion in 11 years, you're going to have volatility. You can't get from 0 to $1 trillion in a straight line. Over time, that's going to mitigate. There'll be much less volatility. It won't be non-existent, but it'll be much more mainstream. And when that happens, I think naturally we'll see the over-collateralization disappear. And there'll probably be a whole bunch of other reasons why it mitigates as well, including competition.
Miko?
Yeah, I mean, just a brief point, which is, I think identity is a form of staking, and I think one of the things that's been sort of a third rail in blockchain and DeFi is kind of that whole Satoshi pseudonymity cloaking device, so I think people will consent to yield their identity in exchange for financial benefits and things like credit ratings. And that's going to be part of a mainstreaming effect. I mean, if you want to talk about things like consumer lending, like I think Haseeb already mentioned Celsius, so there's already kind of consumer borrowing happening with very simple and simplistic consumer user experience as well. So I would say, it's definitely, it's all happening.
Well, another thing that I'd want to add to that point is when you think about, so right now you can do secured lending, as Robert said. Almost all the borrowing and lending in DeFi is secured lending. If you want to get a secured loan against a mortgage or against a car, the difficulty with doing this is not just that, well, the cars and the mortgages, or the cars and the houses aren't on chain yet. That's one answer of why we don't have this. But another answer is that it is actually difficult to underwrite individual houses and individual cars. This is one of the reasons why people who do this kind of lending are very specialized, because they know a lot about the particular place where the house is. They know a lot about that kind of car. And so right now, most of these lending and borrowing protocols, they underwrite a relatively small number of assets that are all pretty huge. They have very large market caps. But there's a tremendous economy of scale. You can underwrite 20 assets, and that gets you to hundreds of billions, if not trillions, of assets that can potentially be in the lending protocol. If you want to underwrite a particular house on a particular street corner in a particular city in a particular state, you need a lot of idiosyncratic knowledge in order to underwrite that house. And right now, the ways in which these networks are constructed requires, I don't know, Robert, you tell me where you think I'm wrong here, but it requires a lot of local
totally
knowledge.
Right so far, Haseeb. Keep going.
Okay, great. I'm glad to hear that. I'm glad to hear that I'm right so far. It requires a lot of local knowledge, and right now these systems are not built for local knowledge, they're built for global knowledge. And so I think by the time that we start seeing car loans and real estate loans, or mortgages as they're called, on the blockchain, you're going to see networks that are constructed differently. where you have people who are somehow local who can actually do the underwriting process required to underwrite individual assets like that.
Which by the way, we didn't see in 2008 with TradFi, right? We didn't see that. We saw robo mortgages. We saw all the BS, right? We saw everything basically fake and scale and collapse. So like, ideally we'd see what you're saying, Haseeb.
If you want a really simple roadmap to think about all this stuff, right now, fungible assets are great collateral, okay? This encompasses many different types of things. Eventually, non-fungible assets, you can call them NFTs, are going to be good collateral. There's going to be lots of teams that figure this out. There's a lot of brain power going into solving this right now. You're going to see a lot of different solutions. But eventually, NFTs will be collateral. Eventually, those NFTs might be houses, a specific house, right, in a specific neighborhood. And it'll represent maybe a specific car. And all of these things will start to work, I think, faster than people anticipate.
I personally think that the world, especially the traditional finance world, is starting to learn about the advent of the smart contract and what you can actually do with the smart contract. And they're learning that there are different flavors of smart contracts. It doesn't all have to be on Solidity. It can be on JavaScript. There are other different methodologies and ways of doing things. And that the smart contract is very powerful, that you can put assets on there. You can value those assets. You can have constant validation of the price of those assets because of oracles and oracle validation systems like Chainlink. And I think they're starting to learn that that's capable and possible. And so I think with that continuation over the next few years, I think you'll start to see more and more of those mortgages, of those car loans start to really happen. But I think it's the learning of the technology, especially the infrastructure of the capacity of smart contracts that will enable that. I want to move forward because we have about 8 minutes left. A very significant topic for conversation, especially on the venture side, is valuations. I'm sure you're all really happy to talk about valuations because God only knows that they are quite high these days. And so there's some writing from PitchBook that I want to cite. Venture capital investment in digital assets and blockchain startups hit a record $3 billion in Q1 of 2021 across 239 deals. The flurry of deal making showed once again how the Bitcoin bull market can trigger a boom time for startup investments. So with the IPO of Coinbase, with certain firms like Fireblocks raising $133 million Series C, with some of the other large companies like Dapper Labs raising $350 million, reportedly at a $2.5 billion valuation. Valuations are a topic I'm sure as the investors out there who are listening to this are very, very cognizant of. And as they're talking to venture capitalists like yourself, they want to know what your thoughts are. So Ken, you have been, starting early in 2016 or so with your first fund in this space. You have seen quite the cycle, and I regard you as probably one of the best investors in the entire world when it comes to this. What's your opinion on valuations?
Thank you. That's very generous of you, probably overly generous. There's two parts to valuations because what you're really looking for as an investor is return rate. And I want to put some money in and I want to make more, and I'd like to make more than a certain rate. So there's some hurdle rate which would excite me to make an investment and some which wouldn't. I'm reminded of 2014 when I was lucky enough to discover the Ethereum presale. And I shared it with a number of traditional Silicon Valley investors, not one of whom dug in. And they didn't dig in because of valuation. That was at a time when Ethereum was being valued, I think, around 28, 29 cents a token. So I think you have to put it in context of what the outcome can be. And one of the reasons why we get so upset by rising valuations is we're measuring them against the outcomes of today. But as a venture investor with a 10-year horizon, one of the questions we have to ask ourselves is, will the outcomes in 10 years be the same size as today? And I think it's a pretty safe bet, if history is a guide, that the outcomes in 10 years are going to be much, much bigger than they are today. And I was just thinking the other day, about Aileen Lee terming, I think it was in like 2014 or 2015 when she coined the term unicorn. Today, it is a completely useless moniker because everybody's a unicorn. In fact, we've seen Series A's that are unicorns. And so I guess my short answer is markets like this are going to lead to much higher valuations than markets that are collapsed when there's less competition. But when you have a new and emerging technology that is a generational shift in technology, I think it's still a pretty safe bet that the outcomes can be big enough if you pick the right deals, and that the entry valuation is the least important part of the calculus.
So I'm going to stop you there before we go to Haseeb, Miko, and Robert. You and I talked about this offline. Obviously the market has gone through a bit of an episode over the last few weeks. Do you think this is going to cause a reset in valuations, or do you think this is a blip?
Well, let me say, as an investor, I hope so. I do think valuations have gotten heady. I much prefer to make a deal than compete for a deal in markets like this. And I think this reminds everybody who's got capital at risk that it really is at risk, right? For 12 months, we've forgotten that our capital is at risk, and now we get reminded. So I think this kind of resetting in the market will for certain temper valuations. But again, if the market recovers and fully recovers in 30 or 60 days, memories are not long.
Haseeb?
Yeah, I'll be brief. I want to give Robert and Miko some time. I'll just say, when everyone's confident they're making money is a time when I get nervous about valuations. And generally speaking, the one strategy that I think always works, no matter where you are in a cycle, is to invest early stage. As long as you're backing great founders working on important problems, you're gonna do well. And in a time like this, when everybody is, when suddenly consensus has been built a little bit too easily, we try to skew ourselves early stage.
Robert?
Yeah, I mean, as somebody who's been building in the space and investing in the space for quite a while, building happens regardless of the market conditions. And sometimes building is best in a bear market when there's not as much noise, and when the people that are actively raising capital and building are the ones who are most devoted to what they're working on. And I'm also hopeful, for different reasons than Ken, that things cool off a little bit, because I think what we'll get is more capital and more effort going to things that are most needed to be built. Less to Seiff Moon and Shiba and all of the memes, to be honest, right? That are not useful for society. They're fun to gamble on, but it's not going to make our industry better. It's not going to make finance better. It's not going to make the world better. And so I'm personally, optimistic that things do cool off a little bit. I don't think anything in a 1 week time frame matters that much, but I do hope and expect that over time, the pendulum will swing back to, a level of seriousness that I think is, necessary for the really good stuff to get built.
And then Miko will get to you, but this is the reason why I believe that venture is so important in this ecosystem. It's the mindset of having not the focus on the next day, but the next year, the next 10 years, really is the mindset of the venture capital investor, who is obviously, as Ken alluded to, being mindful of risk, but has the ability to think he or she into the future and how things will happen, what narratives will happen, what type of possibilities there are. And I think that's really important, especially during a period of time like we've had over the last 2 weeks, just to remind ourselves that, again, we're thinking about the future here and we're building the future as of today, right now. Miko, to you.
Yeah, I mean, I think long-time preference is absolutely reasserting itself with this crash, which is good. I don't know if it'll be reflected in valuations because VCs are raising $100 million funds, present company invited, so it definitely is deployment continues, right? But to me, when I see like super hype kind of founder valuations, two guys and a Doge for 50 million, I start to think, well, if Trade Republic is going to raise 900 million, then we'll just continue to double down on Celsius. Or if Fireblocks is going to raise hype, then we'll just double down on Credo. And if Chia is going to raise big, then we'll just double down on Space Mesh. So at some level, like, our mood is, we do, since there's this amazing scale invariance in some of these opportunities, we can continue to sort of reserve dry powder for, the entrepreneurs that we trust the most. I don't know if that's overly kind of a defensive thing to say, and I think the other impulse that Haseeb pointed out of going really early is also super good. So, I guess do both.
Very good. I think the last question I have, and then we will depart, and thank you for all of your insights into this space. It's been invaluable, and everyone has been commenting thus far. There is a question out there, and it's kind of an overarching question. A bunch of people asked it in different formats and ways, and I'm going to try to condense it down. And I think of it just this way. If there's one thing at night that you think of or that wakes you up and that gets you concerned over the course of the next 5 to 10 years as investors, what would that be? And we'll start with Haseeb.
I was going to say 816Z, but I'll give it the answer.
That's a funny one. I like that.
Yeah, I think the thing that worries me the most is that I think Robert put it very well, is that the space doesn't get sufficiently serious.
Robert?
I actually think it's, at least being a U.S. builder and a U.S. investor, I think the biggest risk is that our government and our society doesn't encourage innovation and takes the opposite approach. I think this is a very, very fragile time for our economy, for innovation, and for crypto as an industry. And my biggest fear is that for the wrong reasons, our society and our government takes the wrong fork in the road.
Miko?
Yeah, I'm totally with Robert, which is that this feeling is really about, I describe freedom as consent to rules, but it's rules of your choice, right? And so in a sense, I'm really pointing at a world where we all have lots of options and we can just choose to go where we feel the best supported, right? But obviously the two forces that kind of work against that are people who are not choosing systems that are favorable for them, because they're aping Dogecoin, and then the other thing obviously becomes, that consent gets manipulated by either, governments and regulators and corporations or other actors, right? But, ultimately, if we're successful, then people will experience this freedom, and when I say people, I'm really hoping for all people to experience this kind of freedom.
Agreed. Ken?
Well, I agree with all of that. I would say that the thing, maybe one sort of half twist on Robert and Miko's answer is we've seen jurisdiction shopping. So the U.S. coming down adversely on the sector, I think, has an impact. It's going to mean we're going to have to fly a little more and do more Zoom calls. But the innovation isn't going to stop, and the opportunities to invest won't stop. They're just going to be in different jurisdictions. So what worries me more than bad decision-making in the U.S. regulatory environment is a collusion between 5 or 6 governments globally around regulatory controls that are bad, right? So regulation is good generally because it clears up a lot of unanswered questions, but stopping innovation through regulation where you have very large countries colluding together to do it, I think is probably the thing that might keep me up at night. The offsetting variable is I don't think governments around the world are talking to each other right now, and they're certainly not collaborating successfully like they were able to do for the prior decades. So I think it's a pretty low risk probability, but it's always, of course, a possibility.
And I'll just finish up on mine. I would say that the last year, especially during the pandemic, that the narratives that we thought would be at play for the next 5 to 10 years, whether that's a focus on decentralization, a focus on a non-sovereign controlled money like Bitcoin in the face of global inflationary issues, and some of the other narratives at bay, especially with DeFi and NFTs, have accelerated so far and so fast because we've all been home, we've been in quarantines, we've been dealing with this horrible pandemic for the last year. And that when that starts to quell, and we're starting to see that now with countries and states and cities opening up, that people realize that what happened over this last year was extraordinary. that the building and the speed and the velocity of interest and money coming into this was extraordinary, and that there is a real here. Yes, there's volatility in the space, but with a new paradigm shift with decentralization, distributed networks that we're building today, that we're very cognizant that what happened this past year does not necessarily have to happen every year, that it will continue on at a more stable growth pace and trajectory. And so that's just my last thought on that. I wanted to thank all of you, Ken, Haseeb, Robert, Miko. Fantastic insights. Thank you all for that. We really appreciate you coming on for this today and joining us. The next panel will start in roughly 5 minutes, and please stay on for it. You have the digital securities panel, the evolution of financial markets. You have some very, very prominent builders and folks in this space that are coming from Symbiont, TP, ICAP, T0, Vanguard, Symbiont, and our own Arca Labs. So please stay with it, and thank you all for coming today.
Thank you, David.
Yeah, thanks so much.
Robert and Miko.
Yeah, thanks,
Bye,
guys.
Great.
See you
Thanks,
in
everyone.
Miami.